Hey everyone, it's Brad Wozni here, and I just wanted to share with you a little presentation I've put together in response to the inquiries I've had from people kind of asking, what it is that I've been doing in the marketplace and how it is that people could get involved as real estate investors, and also what is going on in Chicago's marketplace. So I'd like to introduce to you this quick, short little video and share with you how investors are cashing in on and earning secured returns in Chicago's growing marketplace. Now, here's what you'll discover. First, I'll share with you who we are and what it is that we do, and why Chicago is becoming an exploding market. We'll dive into some of the statistics and real-time analysis here so you can see that. And then what I'll do third is take you through a case study, a little walkthrough of a Chicago fix and flip. And in that case study, I'll teach you how investors can secure their money at real estate, how it is if you're brand new, you can read the numbers, what to expect as a return on a single family fix and flip, and how investors are getting paid even on the worst day. So hedging your risk. Now, I'm a real estate investment property wholesaler and acquisition specialist. And this means my team and I get the hard to find, deeply discounted deals in the marketplace. Investors in town actually come to me asking me for the best deals. Now, we achieve this because we build key in-market relationships and are highly responsive where we contract with motivated sellers. Now, since we provide motivated sellers with quick solutions and peace of mind, we can then close quickly with cash, so I end up buying property at deep discounts. And I'll share an example shortly. What this does, though, is it delivers a true win-win-win scenario for the seller, for the investor, and also for my team. Because you see, most investors are out there harvesting the MLS, and you know what? The MLS is pretty much for suckers. It's pretty much being picked over on a daily basis, especially by a lot of newbies. So now, not only do we flip some of those hard to find, the deeply discounted deals to other investors, of course, it affords me the opportunity where I get the first look advantage to cherry pick some of the deals from our pile and fix and flip them myself. So here's why Chicago and Cook County in Illinois is poised for explosive growth in the housing market. As an investor dipping your toe in the marketplace, there's three key factors of success you look for in the first wave of an appreciating market. And those are jobs and location, mortgage incentives for bank financing, and the opportunity for growth to know that you're in the first wave. And look, Chicago and Cook County, which Chicago is a part of, those of you that don't know, it meets those criteria right now for the following reasons. Cook County itself is the second largest county by population in the United States. It's second behind Los Angeles County. Chicago, the city, also known as the Windy City, is the third most populated city in the United States. Here we can see from the Census Bureau that the entire population of Chicago in 2014's estimate for census was 2.72 million. Look at that compared to LA and then New York. And finally, we're looking at one of the top 5 US distribution hubs via air. There's Chicago Midway Airport, and there's O'Hare via rail through Great Lakes shipping on Lake Michigan, and highways throughout the United States that connect it through the rest of America. And here's one of those great factors of the opportunity for growth from Sperling's Best Places to Live. It was quoted in one of their articles that the future job growth over the next 10 years in Chicago, Illinois is to be 33.3%. And that's virtually astounding. Those jobs will create people who need to rent condos in town, buy condominiums, buy homes, have places to live so they can commute to and from work in the city of Chicago alone. We're not even talking about the suburbs. And here's another great thing about the opportunity for growth. The current mayor, who used to be the White House chief of staff, has taken a very entrepreneurial purview at Chicago and Cook County so that it can compete on the global stage. And in this article from Crain's Chicago Business Magazine, December 2014, we can see that 36 companies that they had quoted, including Fortune 500 companies such as ConAgra, have moved their headquarters to Chicago. So we have in-migration for jobs, job creation. We have more companies that are moving their headquarters to Chicago, and we have an incredible distribution hub. So let's take a look at this case study now in the Chicago fix and flip. And this is how real estate investors and passive private lenders they're cashing in on and earning secured returns in Chicago's starting to be exploding and will be an explosive market over the next few years. Now, here are things that you'll discover and I'll teach you. The first is myth busting. There's some people out there with the adage that it's too hard or it's too time consuming. And the second is you got to know your numbers. So I'll teach you the numbers that real estate investors should know for a single family fix and flip, as well as the lingo, the language that's used in the real estate investment community for single family homes. And the third thing that you'll learn is how to protect your downside, how it is that you can hedge risk in a worst case scenario. And I'll show you that right here. But first, let's look at myth busting and explain it. Let me ask you this. Have you ever heard the phrase, you should always hook your wagon to a rising star? We've all heard that, right? Heck, rock stars do it all the time. Think about it. One moment, a mostly unheard of band is starting to open concerts for the Rolling Stones on a world tour or Pearl Jam, and the next, a year or two later, they're winning a Grammy because they get known, they get discovered. Well, the same concept applies to being an investor by hooking their wagon to a rising star, and especially important if you're just starting out. So let's see this. If you have the cash, then you could simply just go buy a deal from one of the rock stars in your market who's wholesaling deals to investors. Then what you do is you go and you assemble the inspectors, your contractors, manage the rehab work or have somebody do that for you, interview a couple of brokers, realtors, sign a listing agreement, and put it on the MLS to resell the property and enjoy your profits. Because right now, to get into the game, my opinion, the easiest and fastest way to get involved is to connect with the real estate investor who's in your market and regularly sourcing those hard to find, deeply discounted deals from motivated sellers. This goes for any market. And this means nearly all of the heavy lifting work, it should already be done for you, completely done for you. Because if it's their full-time business and not yours, they should be set up and delivering deals with juicy returns to you on a silver platter. They should be the ones getting calls from agents or bankers to come out and look at their hidden inventory or to check out their pocket listings and figure out which of those investment grade properties they want to buy from them, all before they hit the MLS. They, the rockstar wholesaler in your market, they should be handling inquiries from people like estate attorneys, government asset managers, and meeting with motivated sellers in person at their homes. These are motivated sellers who don't want to publicly advertise or admit that they're in a compassionate situation, but they must sell their property ASAP. Now, what I just explained is one option for you. The other is to go and set this entire business up on your own. And then again, we get back to it would be too time consuming to do so. Which brings me back to the first point and the adage to find the local rock star in your market and start a relationship. Unfortunately, real estate investing, it's not rocket science. In fact, it's actually simple math, and it's very easy once you understand the numbers to look for. Which means the next step is for you to understand the numbers you need to know for single family fix and flips. And once you've nailed this down with some key lingo, you're in good shape to move to the next step. So here's the first lesson in knowing the numbers. Number one, rehab real estate, remodeling properties. It's all about the fixed up value of a home. The lingo used by investors is the acronym ARV for after repair value. So unlike the stock market, when you don't know what the price of the stock will be in the next second, minute, hour, the next day, or the next month, with real estate, for example, in single-family homes in a great market, if we know that a remodeled 3-bedroom, 2-bathroom, all-brick bungalows within the same area, we know if they're selling for $140,000 today, then there's a darn good chance that this price will be the one that they'll be at for a month or even 6 months from now. And heck, if you're investing in a market that's rising, then there's the potential of factoring in a little appreciation as well and making a little bit more at the end of the day. Warren Buffett calls this value investing. This is where you buy something significantly lower than its true market value, the ARV. With real estate investing, like with Warren Buffett in the value investing model, you make your money when you buy and you realize it when you sell, again, provided you know your numbers. And the second number to understand is the repair cost. Quite simply, this is the estimated cost to fix up the house and bring it up to the area ARV. And third, we do a little basic math. So we take the ARV minus the RC, repair cost, that equals the AIV. The AIV is the as-is value of the property. This is usually the list price when a house is listed by a real estate agent, for example. Therefore, ARV minus RC equals AIV. This is your formula. And the key is to apply these numbers in an active area with active rehabs and resales of remodeled rehab properties taking place. That's what you want to focus on. So now you know your numbers. Let's look at our case study in even a worst case scenario. This is how real estate investors and passive private lenders are cashing in on and earning secured returns in Chicago's exploding market. So let's take Muskegon, for example, in a deal we've done with one of our investors. This is 12632 South Muskegon Avenue in Chicago, Illinois. These are part of the before pictures of the property. Now, we know in this zip code at that point in time that the ARV for this type of a property as a 3-bed, 2-bath fixed up would be at least $135,000. We also determined that the repair cost would be $45,000. And we figured out, based on our formula, that it's roughly a $75,000 AIV, the AI as it sits value today. Well, we were able to buy this property for $48,432.09. That equals 69.2% of the overall ARV. So basically, what you're doing is buying a property and you're all in on the property for just under 70 cents on the dollar. And this is one of the great ways that investors can hedge risk even in a worst case scenario. So after just a few months, the property is now fixed up, turned around, and resold on the market for $135,000. You see, there's some key secrets to success, and you've already been learning them. First of all, to buy cheap, successful real estate investors must pay cash in order to close fast. Simply, traditional banks are too slow and cumbersome to move quickly. And by paying cash and moving fast, moving and closing in 10 days or 14 days or even 4 weeks, they can beat out other investors. It's the old adage and the statement that you can't steal slowly. And when you're getting properties at a steal of a price, you need to move quickly because there's other competition in the market that is trying to undercut you. Enter private lenders. Private lenders are everyday people. And this creates an opportunity in real estate investing for passive investors, who we call private lenders, to participate in real estate profits without ever owning houses. And here's how it works. We got an accepted offer from the seller to buy Muskegon Avenue for $48,432.09. Well, we estimate the repair costs at $33,000. We estimate other costs, the holding costs and the cost to pay our team for sourcing the deal and the marketing and the overhead in the business at around $12,000. We borrow $100,000 from a private lender. Again, private lenders send money to the closing agent, not us. The closing agent then records a lien on behalf of the private lender at closing. So the private lender's money is secured by the real estate. That $100,000 loan is secured by a house valued at $75,000. And the private lender is paid 6 to 10% interest for the use of their money, and we know that the ARV is then $135,000. The relationship between the real estate investor and the private lender, this is what creates success. When you're buying at 50 to 60% of as it sits value, you have a tremendous advantage in the market. Typically, we're going and getting off-market houses. These are usually not listed on the MLS. Those are homes that I would say are not accessible to the general public. And so where are some of those off-market houses coming from? You can write this down. Well, we send out direct mail to tired landlords or vacant houses or evictions. We get word-of-mouth referrals from different attorneys and title companies and real estate agents, for example, and other investors. And there's online advertising and probate sellers and so on. Those are just a handful of them. Like I said before, I get deals no one else can find. Other investors call to buy from us. And this means we know investors who are looking for relationships with private lenders nearly every day to finance their deals. If this sounds like a relationship you'd like to know more about, or if you'd just like to learn more about how private lenders are making private loans and securing their money against the discounted real estate, then just pick up the phone and call me. You can speak to me directly at 312-818-3893. Very simple number, 312-818-3893. And the voicemail box is checked once a day, and myself or one of my staff will arrange a time that we can have a conversation.